I mean, he was right during COVID, in the dark days of COVID. I just don't see it, though. And so what Tom is saying is, well, the market can go higher as long as we know when the Fed's going to stop. But when the Fed is telling us they need months and months of data, and we have not been in this inflationary environment in decades. So anyone going back and saying, when you look back at previous Fed hikes, if you're talking about the 2000s, throw that out the window. And so you have the consumer is slowing, which is 70% of the GDP. GDP is slowing. The Fed is tightening into a slowing, stalling economy. And guess what, Scott? We have QT starting next week. And so I just don't see how we have this V-shaped rally over the next 4 months to end where we started in January, just because the ingredients aren't here. Because also, you think about this, Jay Powell, every single word was scripted. When he's using words like pain, that's a very specific word. He's trying to tell us and tell the market and tell the Americans what is to come. And so if we are going to have a recession sometime in 2023, I also don't think the market will whistle past the graveyard and just race to 4,800. So I think Tom is great. I get what he's saying. I read his research. I just think we're going to be in a much choppier market. The trend lines on the S&P and the NASDAQ, we are making lower highs and lower lows. That has to reverse first of all, and that we're going in the wrong direction right now. So I'm in the camp that we are going to chop along this until we get nicely over the 200-day moving average. I don't think we're even close to start moving in the direction that Tom's talking about.
I'm going to distill what you just said, Bryn, as I throw it back to you again for a follow-up of 4 words. Don't fight the Fed. That's exactly what you're saying. Yep. That's essentially what you're saying.
I am saying that, yes. I mean, we've written multiple pieces. I've said it all year long. Don't fight the Fed, because there are 2 people in charge of this market, the Federal Reserve and the algos. And, earlier you, Liz, and Joe were talking about the market moving up in July and early August. Well, we had one of the biggest short coverings in years. And so that energy of what's happening with the algorithms and the hedge funds doing that massive short covering was a huge part of the rally. And then, we bounced right off that 200-day. And so once again, the Fed and the algos are in charge. Don't fight the Fed. We're invested. We're buying companies, right? We have a lot of stock, a lot of new clients with cash. And so we're dollar cost averaging. But the way we're doing it is smaller amounts, longer time. Because I think there's going to be opportunities to pick up really good strategies and companies here. But anyone thinking that we're going to go straight back up, I think, is not managing necessarily clients' expectations to what probabilistically will happen.
Now I turn my attention to Mr. I'm thinking of buying the Qs. Words that you stated multiple times this week. That would seem to fly in the face of don't fight the Fed. Does it not? And are you still thinking of making that trade?
Well, first of all, I haven't bought the Qs yet because you know me well enough to know I like money more than I like being right. OK, so I'm sitting back patiently with discipline, waiting for an opportunity. I think the downside,
a 4% decline today might be deemed an opportunity.
You're back into the moving averages right here, a little bit below the 100-day moving average. I'll probably wait a couple of days before I put that trade on. But from the perspective of how you strategically want to approach the market, this is what I believe is going to be working as we move forward. I think the downside is protected by the chairman's comments that the economy, as a result of his actions, is going to contract. What does that mean? That means that the price of oil is going to move lower unless you get some form of an exogenous supply shock. As the price of oil moves lower, that's going to buffer and protect the downside.
Yeah, but you're painting a pivot picture again. Maybe not wrongly. Maybe not wrongly. I mean, if you say that economic conditions are going to deteriorate,
and oil will go down in that environment.
But if economic conditions deteriorate, that will, in theory, cause the pivot, the great pivot that everybody thinks is going to happen.
I'm not. My thesis is not predicated on a pivot. What I'm just saying is the downside is protected. Do I think that you could be a passive index investor? And Bryn is talking about not getting to 4,800 again for the S&P. I don't disagree with that at all. But I say don't be an index investor. Be a strategic investor. Understand that growth at a reasonable price, quality growth comes back. I wouldn't be investing towards cyclically sensitive businesses. I wouldn't be investing towards hyper growth, I would be investing towards healthcare. I would be investing towards mega caps. In an environment where growth is scarce, you want to invest strategically around that type of growth. I would be a strategic investor, not an index investor.
Liz?
I agree. You have to be more specific in an environment like this. I am not, at this point, comfortable with going full on into technology. And if that means the Qs, that means the Qs. But because you have to think about what gets punished in this environment. As the Fed keeps raising rates, which they will, tech, communications are going to continue to get punished, and there's a lid on the opportunity. If you want growth potential, I completely agree with healthcare. And you have to think about, too, things like consumer discretionary. What if the consumer does end up holding up? And even if the labor market softens a little bit, consumers keep spending. Think about what is the growth that could get us out of this. I think it's more like healthcare and consumer discretionary.